Namaste, welcome to Arthaniti. Today I want to discuss about the curious case of AT1 bonds, additional tier 1 bonds. Uh, all of us must have read the news about the Credit Suisse crisis, how Credit Suisse was having liquidity pressures, how it approached its Saudi investors to pump in more funds into the bank, but they did not come forth. Then Credit Suisse had to knock at the doors of the Swiss National Bank, the central bank in Switzerland, correct? They extended a credit line of $54 billion. But guess what? That credit line was not enough to keep Credit Suisse afloat. Finally, on Monday, which is 20th of March, UBS took over Credit Suisse at 60% discount over its previous trading price. UBS bought Credit Suisse for $3.25 billion, correct? On Friday, the previous market closing day, the market capitalization of Credit Suisse stood at 7 billion, whereas each share of Credit Suisse was getting traded at roughly 2 Swiss francs per share. On Monday, a straight devaluation of 60% in a matter of 2 days. Correct? So, whoever had invested in Credit Suisse on Friday would have seen erosion of their investments by a straight 60% over the weekend. Correct? Therefore, always prefer value investing rather than investing in price corrections. But that apart, let us focus on the topic of our video. Why did I choose this topic today? Well, when this merger of UBS, not merger, it is basically an acquisition of Credit Suisse by UBS was announced, one startling thing that has happened is what when a company takes such major decisions, they need shareholders approval, correct? But in this case, in this takeover, the central government of Switzerland has ratified their laws as this acquisition has gone through without shareholders approval. Can you imagine any company, when it takes such major decisions, such strategic decisions, shareholder approval is a must as per the Companies Act? But the government has modified those laws so that this acquisition goes through. Can you imagine the stress at Credit Suisse, because of which the central government of Switzerland had to take such a huge step, right? FINMA, the Swiss regulator, like we have SEBI in India, FINMA is the Swiss regulator. It has completely written down $17 billion worth of AT1 bonds. So $17 billion became zero as per FINMA regulations. Correct? Now, all those investors who had put in money in these hybrid instruments, their value has turned nil. Correct? This was a deja vu moment. Why am I calling it deja vu? 3 years back in 2020, Yes Bank in India faced a similar situation. It was on the brink of bankruptcy. RBI then had regulated that AT1 bonds of Yes Bank be written down completely. All other banks, major banks like SBI, ICICI, Axis Bank had chipped in, had come forward to purchase stakes in Yes Bank and help Yes Bank out of the crisis it faced in 2020. But AT1 bond holders who had invested in those bonds in Yes Bank, they saw their value becoming nil as per RBI guidelines. So this was somewhere similar to the situation. The Credit Suisse situation is somewhere similar to the situation with Yes Bank AT1 bonds. So in this video, I want to tell you what AT1 bonds are. Well, AT1 bonds are high risk, high interest yielding instruments. Higher the risk, better the returns. All of us know this, correct? So they are a high risk instruments with a capacity to earn high returns, correct? They have similar characteristics like equity shares, in the sense what, banks issue these bonds to raise capital, do raise capital so that their funding requirements are met in times of stress without them reaching out to the government for help, correct? So basically 81 bonds were introduced as per the Basel 3 guidelines, banking guidelines, to protect the interest of depositors following the financial crisis of 2008. So these bonds were issued as per these Basel 3 guidelines. These are perpetual in nature, so these bonds do not have a maturity date. Okay, they are completely unsafe. Because of this riskier nature, the returns that these bonds earn is also relatively very high. The value of each such bond in India is rupees 10 lakhs. The bank can redeem these bonds in 5 years or 10 years, or no, or not redeem them at all. The bank can keep on paying interest on these bonds year after year, but say in some years where the bank is unable to pay the interest, these interests are not carried forward to the next year. So basically the investors in these bonds lose out when the bank do not pay interest, correct? What happens is, in case the bank faces liquidity crisis, these bonds are converted into equity shares by the bank. So they become, these bond holders become equity shareholders as per this is the characteristics of these bonds. Okay, now like Yes Bank, the bonds with Credit Suisse also became zero, right? So what is the difference between the situation at Credit Suisse and what is the current situation of these bonds, 81 bonds of Yes Bank? Let's check. As I told you, the Credit Suisse bond, 17 billion worth of them became zero, right? Equity shareholders, yeah, who the last trading price of Credit Suisse share was somewhere around 0.90 Swiss francs a share. So equity shareholders, even though will get peanuts, will still get some value for their investments, but 81 bonds are completely wiped out. In case of Yes Bank as well, 81 bonds were nullified. The investors did not get any penny for their investments, but the share price, even though it reached the lowest possible during this debacle in 2020, has again risen, if not to its old levels, but still some value for the shares the shareholders will get, correct? 81 bond holders of Yes Bank approached the court after the RBI ruling to nullify them. They alleged that the relationship managers and management of Yes Bank had missold these bonds to mostly retired people who have that kind of a corpus of investing in investment products with high value, correct? So these were basically sold to retired people and with and were termed as super FDs by the relationship staff of Yes Bank. And the ruling of Bombay High Court to stay the RBI order was recently on 3rd March this year, was reverted by Supreme Court, saying that the nature of these bonds is such that they are high risk. And it was, see, it is always remember the principle of caveat emptor, buyer beware. Yeah, anybody tomorrow can tell you anything. You get influenced easily, put in your hard earned money and lose your money. There are varied scams that go around. But when you are putting your money, which you have relentlessly made efforts to earn, please ponder over where your money is flowing, what kind of instruments your money is getting invested in. Correct? All knowledge is available on Google. Correct? With just type in and read about it, because unless and until you are sure where your money is going in, you later on cannot lament that you were tricked by some people to put your money into a particular instrument. Correct? So this principle of carrot emptor should always be on top of your mind when you are putting in money in some financial instrument. Correct? So let's see what happens with the Credit Suisse AT1 bonds. But remember, if you are being sold any such instruments which is new, which has a capacity of earning better than average returns, your alarm bells should go off. You should give it more time, read about it, talk to people about it, ask me if you are unsure, and I will be happy to help you, give you correct information and help you take right decisions. Correct? So I hope you have liked this video. Any questions that you have about AT1 bonds, please feel free to comment below the video and I will be happy to help you. Until next time, happy investing, be safe.